This is Kelly O'Connor with Mountain Financial. One of the most important conversations we have with individuals is regarding their mortgages. There is a lot of misinformation out there. What we want to make sure we discuss first is what is the bank's biggest concern? Because if we understand that, then maybe we'll have a better idea than of making a proper decision financially about our money if we understand what the bank is concerned on their side and how they're going to make the money. And obviously, if they're benefiting the most, then we would just simply do the opposite, and it would make sense that we would be in the better position. So we will often ask, what is the number one concern of banks regarding your mortgages? And most people say the risk, right? Credit worthiness, etc. But inflation is their biggest concern. Let's take a look, and maybe we will end up making a different choice in how we handle our mortgage. Let's face it, there are very few assets that are structured like this. A home is one of the only assets we have, if the only, that is a part of our accumulated money, right? Part of those funds that fall into our accumulated pile, because there's equity and we're hoping it grows. Certainly lifestyle money that, you don't have to buy the $400,000 home. You could buy the one-bedroom condo. So there's lifestyle decisions. And what we educate on, transferred money that we're losing unknowingly and unnecessarily by just simply the decisions that we make. Because let's face it, there aren't many assets that have $300,000 loans against them. So how we handle this is absolutely critical. So let's take a look at just a couple things here. This number one on the left represents today, your very first payment on your brand new mortgage. Month 180 is year 15. Month 360 is year 30. Now, this conversation is very simple. I actually had this the very first time. I did it on a napkin with a real estate agent having coffee. He asked me to create this so I could help educate his agents, and I just simply did. I just put it in a simple PowerPoint. It's a great napkin discussion, but there's nothing super fancy about this, so just bear with me on that and follow along. But so let's take a look at a couple factors. First of all, we know that the banks offer lower rates on a 15-year than a 30-year fixed, and we have our payment. So for this example, let's look at a $1,000 payment today, and let's go ahead and use a 3% inflation calculation. Now, today, that payment, we write that first check for $1,000. It feels like $1,000, right? That $1,000 has buying power of $1,000 to you today. That represents a current buying power value of $1,000. Now, just using 3%, at month 180, you're still writing the check. It was a fixed payment. You're still writing that check for $1,000, but it feels like $642. I mean, I would love to have my first house payment from back when I was 25 years old. Back then I was freaking out. I'd love to have that one now, right? It happens. This 1,000 will feel like 642. Now at month 360, year 30, it'll feel like 412. Now wouldn't it be great to be able to write all the payments, all the checks, right at the very end when it only feels like 412? Well, you bet, that would be cool. So along the way, we're making this payment, but the value of what that payment represents in our circle of wealth, if you will, is smaller, right? It feels smaller. Now, the bank is also in this mix. What does your $1,000 represent to them? If it's buying power for you, what is it for them? It's collateral power, right? Because the bank takes that 1,000 and they leverage it to bring 100 in. Then that 100 brings in 10. Then that 10 brings in $1, then 10 cents, then a penny. Right? Traditional banking leverages every dollar that comes in 5 to 10 times. So this $1,000 worth of payment from you to them represents $1,000 worth of leveraging power to them. At year 15, it feels like 642 to you. You're a little bit happier. They're not, because that represents only $642 worth of leveraging power. At year 30, you're very excited because your payment feels like only $400. It's a breeze. They're not excited because it only represents $412 worth of leveraging power to them. Now, if we were to highlight right here, say a 10-year ARM, a 5-year ARM, a 3-year ARM, each time we get lower and lower, closer to the most current representation at year one there, the rates get less and less and less. 5-year ARM has a little bit higher rate than a 3-year ARM. The 3-year ARM has a lower rate. Now, why is that? Because they know they're going to get every dollar back, all of it, when it represents the highest buying power to them. So we have to ask ourselves a couple questions. First, do the banks have your best interest at heart? And everybody says no. I mean, it's not that they're, bad, but they represent their interests. They're there to make money, and they provide services for us, and that's great. But their decisions are based around their profitability. So if they don't have our best interest at heart, and we can get a lower rate on a 15-year than the 30, then why are they promoting the 15-year? Well, that's interesting because it counters what they tell us. So let's look at what we're told. We're told, and these aren't using the 3 1/4 interest rate, this is just very general, but this is what we're told as a generality, that if we get a $200,000 mortgage, we're going to pay $80,000 in interest over the 15 years. We're only going to pay $280,000 total. This is what the financial entertainers of the world love to tell us. And then they say, but see, if you do the 30, you'll get the $200,000 mortgage, but you're going to pay $200,000 in interest for $400,000 total. That's a savings, quote unquote, of $120,000 if you go with the 15-year fixed. Now, this is what we're told. And it's very easy to look at that and say, yeah, that's right. But it doesn't make sense if we know the bank doesn't have our best interest at heart, and they're giving us an incentive, and a big incentive, by 3/4 of a point to go with a lower term. Why are they possibly walking away from such profitability if it represents $120,000 more? It doesn't make sense. It doesn't line up, because what that would lead them to is, if that truly was the best decision, then they'd be offering us 50 and 60-year mortgages. They would be giving us the incentive to go with the 30-year fixed, right? Because even if the rates were different, if it's 4 on the 15 and 3 1/4 on the 30, but we've amortized it over 30 years, they're still going to collect a lot more interest over that time. So why not give us 50, 60-year and collect a ton? So it is not in the bank's best interest to stretch it out. They make far more money. They make so much more profit on a shorter term loan than they do the longer term. They don't care about this $120,000. They want to leverage your money when it has its highest value. Would they rather leverage 5 to 10 times your $1,000 payment when its buying power represents $642 at the very lowest, or when its buying power represents $412 at its lowest? They want the short-term notes. It's math. They make 10 times more money on the shorter-term notes because of how they leverage the dollar. So let's take a look at a couple things. Let's look at historically. Now, back still in February of '99, towards the end of Bill Clinton's time, economically we were booming. There certainly was not a big inflationary concern, right? We weren't in a position where inflation was considered much of a problem. Well, look at the difference. You can Google this. The 30-year average mortgage was 6.89, the 15-year 6.51. So for those mortgage people out there, it's about 0.375, the 3/8 as they call it. So on the site that I looked this up, they showed the difference at 0.38%. So the banks then weren't that concerned about the difference between the 15 and the 30. There weren't big inflationary concerns, so them being extended out 30 years wasn't much of a problem. But let's fast forward to 2012, when we had a lot of inflationary concerns really beginning to take hold. The national average at this time for the 30-year fixed, 3.9. For the 15-year, 3.2. That's a difference of 3/4 of a point, double what it used to be back in '99. They increased the incentive 100%. They doubled it. Now, why would they possibly do that? It's because of the inflationary concern. They are scared, as many of us. We need strategies and solutions in our own life to deal with inflation, and you better have liquidity, because that's really it's not about rate of return, it's about liquidity. And the bank is fully aware of that, and they're offering us huge incentives. Listen on the radio. It's the only mortgage you hear advertised. They're advertising the 2.875, 30, or 15-year fixed. Have it paid off before your kids go to school. That's the one they're marketing, providing the most incentive for. And here we are thinking the math makes sense, and we're sending our extra dollars. We're accelerating our payments by doing one extra payment a year or $500 a month. We're giving them our most valuable dollars sooner. Now, what do they give to us for that? If the bank is getting our most valuable dollars sooner, what does that mean they get to do? It means they get to leverage. You lose buying power. If you put $500 extra dollars, so your payment's $1,500, you're giving them $500 extra dollars per month. You're losing buying power with that money over the course of that loan. But they are gaining leverage on your most valuable dollar. Now, but again, we think we're saving interest. But we are not. And it's basic math, and we can dig into that deeper. Trust but verify. We verify the math on this. But let's take a look. Let's stay out of some of the math and just stay conceptual. You are sending your most valuable dollar sooner. They're very happy to do that so that they can leverage. They make far more money on shorter term notes than they do a longer term. And if we're accelerating it, that's all we're doing. We're shortening our term. So we have to then ask ourselves, does the bank pay us any interest on that additional principal? Meaning that $500 a month, if you did that for a year, that's $6,000. You do that for 2 years, that's $12,000. So at the end of that 2 years, you accelerated. You paid $12,000 extra that, according to your note agreement, you did not have to. Does the bank give you any interest on that additional principal? No. That $12,000 isn't worth $15,000. Now people will say, but I saved interest on the back end. Well, that's different. It's totally different. It's easy to have us focus on that, but that's the wrong side of the coin. We got to turn the coin over and look at the correct side of the coin. Do they pay us interest on that $12,000? So do they say, hey, thank you on an annual statement, thank you for accelerating it, and because you've accelerated it, we've credited 10% interest to that $12,000 that you've sent to us? And no, of course not. If a home is free and clear and the identical house sitting next to it is mortgaged, there's no difference in value. The homes are valued the same. Mortgage balances do not determine the value. We don't earn any additional principal or interest on the principal we've paid in. Now, what happens if you need it? You paid the $12,000, you have a kiddo, and you decide to have your wife stay at home. The mom stays at home. Or there's a job change. Whatever. Life happens. And boy, you could use that $12,000. If it was sitting in your tin can, you could have pulled out the tin can and fixed the water heater, whatever. But you need the $12,000. Do you have access to it? No. Not without qualifying. Not without paying fees. Not without restructuring your loan or getting a new one. Well, what are the rates going to be then? Right? So if we want the money, what do we have to do? We have to go to the bank and we have to say, we've been giving you $500 a month for 2 years. We just need $6,000 of it back. We have to qualify. Well, what if one of the spouses lost a job and you don't income qualify anymore? They just simply say, sorry, thank you for doing that, but no. What are the rates? There's all kinds of issues. Rates are a big one. Rates are going to be adjusting here. The inflationary pressure alone will cause that to happen. So what are the rates at that point when you need it? Who knows? Why do you need or want the money? And could your need or want have an impact on whether or not the bank loans it back to you? You bet. Cash out refinances is what they're called. Well, there's a lower LTV, loan to value ratio. You get an interest rate hit when you need to pull your money out to pay stuff off, or just when you just need to pull money out. So all of these aspects here are unknowns. So in year 2, you've paid the $12,000 and you need the money. Well, there's too many what ifs. There's no planning that can be done there. You can't access those funds. What are the rates going to be? What are the purposes behind it? Why do you need it? And could that affect whether or not the bank will give it to you? And what happens if your home depreciates? That's happened to a lot of people. They paid all this extra principal into their home, and their home then also depreciated. So not only did they not have access to the money, it didn't earn anything, but now it's just gone. They put 12 grand in, and the house is worth 20,000 less. That 12 grand is gone. It would have served you far better to just have it sitting in a tin can in your kitchen. You could have at least touched it and used it. So we have to understand inflation. It is the bank's number one concern. It is the reason they give us an incentive. If you are a business owner and you offer a line of products and there's one particular product that you really want to move because it creates a lot of financial opportunity for you, what do? You provide an incentive. Well, this is all the banks are doing. They provide an incentive, and they've increased that incentive in our current economic times of our country because they are scared to death of what 30 years represents to their leveraging power. Therefore, we need to be concerned about what that represents to our buying power and the ability to earn on our money over that time in order to help us offset the impacts of inflation. So, what we would invite you to do, I know you'd have a ton of questions. I know you say, yeah, but, or yeah, but this, or yeah, but that, but what about the interest costs and blah, blah, blah. And that's fine. That's totally natural, of course. We want you to have those questions. What we would ask you to do, though, is understand this financial, economic truth and reality of banking and just be willing to have a discussion to look at your scenario and see if it truly makes sense for you to do that. And I believe you will be shocked to find that it is one of the biggest financial mistakes you can make, again, because of what the home represents. And we want to show you that so that we can make your house as strong as possible, as protected as possible from inflationary pressures going forward and all that that represents. We want to help in regards to that's what we do. That's part of our expertise. We are not mortgage people. We don't do mortgage loans, but we educate mortgage people and real estate agents, and that's what we want to do here. So take some time, reach out. We will show you and dig into your personal information on this and see the impacts of this with you, but these financial realities always stand true. This is Kelly O'Connor. We look forward to talking with you.